A rising Fed funds rate. This all-important rate is the baseline for any interest-bearing product and has major influence on the U.S. economy. But it doesn't have to be scary. Quick history lesson. Way back when, the U.S. economy faced major frequent shocks to the financial system during good times and bad. Fast forward to 1913, and the Fed was created with the goal of alleviating the impacts of financial crisis while preventing economic overheating. Today, their goal is to maximize employment and stabilize prices. Controlling the Fed funds rate is their primary way of doing this. Like a car's accelerator, when the economy needs to get going or some speed, they push rates down. When they sense caution or need to slow down, they lift off and raise rates. Lower rates encourage economic investment, while higher rates discourage economic investment. Think for a moment. Are you more likely to borrow money if someone requires you to be paid back quickly with interest, or are you more likely to borrow that money if someone says, "Don't worry, pay me back what you can when you can"? In today's environment, when inflation is running hot and the economy is overheating, the Fed is starting to take their foot off the gas and lift rates up. They're trying to get the economy to slow down a bit. How does this affect stocks? While the market as a whole tends to be repriced, typically, financially weak companies are negatively affected the most. Their inability to borrow easy money and pay back debts puts them between a rock and a hard place. As some investors see the future prospect of these companies falter, they value these companies less, as seen with decreasing stock prices. Does that mean you should sell your stocks? Maybe. Many stocks have already had the value cut in half or more. If you started investing in these companies with conviction based on their strong financial prospects, then maybe holding and riding this out is the most appropriate thing you can do. Maybe buying more is appropriate. Isn't it buy low, sell high after all? That said, weaker companies with poor future prospects may continue to trudge lower as the going gets tougher for them. Invest the right way, and undoubtedly you'll come out of this stronger than ever.